Hey everyone, George Christie with Wine Industry Network. Welcome to another episode of the WIN Educational Webinar Series. Today's webinar is sponsored by Corporate Tax Incentives, and it's titled Understanding the Importance of Tax Credits for Your Business. Now, this is a really important session that we produced today. Wine Industry Network has actually worked with Corporate Tax Incentives to take advantage of some of the government programs that are out there. And I think generally speaking, there's a lot of opportunity that winery and vineyard operations and even some of our industry vendors haven't been able to take advantage of. And this is what this company specializes in. So the session's sponsored by Corporate Tax Incentives. The presenters today, we've got Mark Echols. Mark is the managing director. He's going to be joined by Michael St. Angelo. Michael is a CPA, and he's also the director of technical sales for Corporate Tax Incentives. So great session. Before we begin, as is always the case, we pre-record these a couple of days in advance. So we do that for quality purposes, but we also do that so that you can have more time to engage with presenters. So both Mark and Michael will be watching this broadcast just like you are. They'll be in the chat room taking those questions on as they come in. So please take advantage of that. And again, I think you're going to really enjoy this one. I think that about covers it. Once again, I want to thank Corporate Tax Incentives, CTI, for their sponsorship. I want to thank Michael and Mark for their time. I want to thank you for taking the time to be with us today. And I'm going to hand it off to Mark. Let him take it from here.
Thank you, George. Appreciate it. I'm Mark Echols with Corporate Tax Incentives. I'm here with my colleagues, Michael St. Angelo and Adriana Burrell. We're going to talk about credits and incentives for your businesses and your industry. And wanted a little bit about our background. I've been with Corporate Tax Incentives for about 9 years now and been doing credits and incentives for over 25 years. I used to work for one of the big four accounting firms before I joined CTI, helping head up their SoCal R&D tax credit practice. Michael St. Angelo is a CPA. He's getting his master's right now at Villanova. He has both project management experience as well as subject matter experts in some of these credits and incentives that we're going to talk about today. And at the end, Adriana Burrell, she's one of our associate directors in business development activities. She's located in Sonoma County and works with a lot of our clients in the wine industry, as well as other industries for these credits and incentives. So today we're going to talk about an introduction to CTI, just briefly who we are. And by the way, one thing I wanted to reiterate and mention is, if you have any questions at all, please submit them through the chat. So we'll try to address as many of your questions as we can throughout the presentation. If for some reason we don't get to it today, you could always reach out to us later and we'll answer any questions you have. So CTI will go through that. We're going to talk a lot today about the research and development tax credit and how it's applicable to the wine industry, as well as other industries and supporting industries. The employee retention credit, this has been a really hot program the last 18 months to 2 years. Michael's going to go through that. We did want to touch on a couple other service offerings that might be applicable to your business. One is the work opportunity tax credit. I'm going to talk a little bit about the cost segregation opportunities if you buy a building or make improvements to it. And then we are a global firm, so we do have some global incentives too. I don't know if you do any business outside the US, but I'll touch on that. And then again, submit any of your questions through the chat and we'll get to them as soon as we can. So corporate tax incentives, we've been around 22 years now, I'm close to it. We are a global firm. We have about 175 individuals. Most of them are located either in Sacramento, California, which is our corporate headquarters. We have a large office also in Houston, and we have satellite offices in Los Angeles, Philadelphia, Denver, and then we do have a London office for some of our global incentives. We're not a CPA firm, but we work with a lot of CPA firms and similar referral partners of ours, helping in these specialty areas, employment incentives, research and development activities that we'll talk about, and credits, cost segregation and training, and discretionary expansion and global. So there's about 5 or 6 service offerings that we do well, that we've been doing for years. And then one of the things that makes us a little bit different in the industry is we're really big on technology. So we really like to marry kind of the tax expertise with the tax technology to just have a better deliverable at the end of the day. It's more transparent. We're going to maximize the benefit for our clients. So, that's CTI. We did want to jump into the research and development tax credit. So even though it's been around since 1981, A few years ago, it was made permanent, which is nice. Before that, the credit, it'd get renewed for a couple of years, and then Congress, would shut it off, and then we'd have to make it retroactive. I think it happened over 14 times since 1981, but it is now permanent. And what it is any companies that are developing anything that's new or improved, either a product, process, or software, they could actually get an income tax credit. So when Michael talks about the employee retention credit, we're talking about a payroll tax. Well, this is an income tax credit. So businesses, they need to be profitable. They need to be paying income tax liability to use these credits. But there's about $15 billion in federal R&D credits that are claimed each year. But a lot of small to medium-sized companies, with less than 100 million in revenue, they're only about 10% of those companies are claiming it. So it's available to anybody. It's not just the Fortune 5,000 companies or Fortune 100. Any business could qualify for this credit. And so it's something that you want to investigate to see if there might be an opportunity. And the nice thing too, it's not limited to any one industry. The wine industry is great for the R&D tax credit. There's a lot of different areas, and we'll talk about those in a minute, that can qualify. But it could be any industry: software, high tech, someone's developing a new software app, agriculture, construction, you name it. So as long as you're meeting the 4-part test, which you'll go through, you can qualify for this program. So real quick, there's kind of two different ways to calculate the credit. I'm not going to go into too much detail, but just be aware of there is a regular credit method to calculate the credit. For well-established businesses, been around since the 80s, there's base period, that 1984 to 1988. And basically, at the end of the day, it's a credit for increasing your research activities over a base amount. So if you're flat or increasing your R&D spend over the years, you might be eligible for the credit. It says it's a 20% credit, but there are some limitations to it. At the end of the day, currently, you're looking at almost like 8 cents on the dollar. So for every $1 million you spend on R&D, you're going to get about an $80,000 credit. And I do have a quick calculation on that I'll show in a minute. For some reason, if you can't calculate the R&D credit with this traditional base period, or what we call the startup rules, there is an alternative simplified credit. You get less of a credit. At the end of the day, it's going to be less than the 20% credit, but it's a quick and dirty way to calculate the credit if you don't have the books and records. And then all you have to do is look at the prior 3 years R&D spend, and you take the average of that and you multiply by 50%, and that's your base amount. So anything you spend above and beyond that, you're going to get a 14% credit. Again, there are some limitations to that. The other thing to keep in mind when we're talking about federal R&D credits is that there's also a state R&D credit. I think 36 out of the 50 states, they have some sort of credit or incentive for research activities. So when we ever do a federal project, we also look at the states that they actually conduct the research activities in. For example, the state of California has a great R&D credit. It's 15%. Again, there's some limitations on that. So we can double dip, if you will, the same expenses. So we can get a federal R&D credit. We can also get a California R&D credit, and it becomes fairly significant with your R&D spend. So that's something to keep in mind, that we're going to talk generally about federal credits, but you can also be potentially your company available for these state R&D credits. So what is research from a tax perspective? Well, there's something called the 4-part test. As long as your activities and your R&D projects meet the 4-part test, then you can be qualified for the R&D tax credit. So the first test is you have a new or improved business component. So what is the business component? Well, that could be a product. It could be, if you're developing a new wine varietal, for example, that would be a product. It could be a process improvement, new filtration systems, new fermentation ideas, and then computer software can also qualify. It could also be a technique, formula, or invention as well. And so that's the first test. And the second test is elimination of technical uncertainty. So at the outset of the research project, there has to be a technical challenge with regards to whether there's capability uncertainty, were the engineers and scientists capable of achieving the project goals? And a lot of times they think they can do it, so that's not an issue. Or is there a methodology uncertainty? So is the method appropriate or not? Or the appropriateness of the business component design. So as long as there's some sort of design uncertainty at the beginning of the project, some technical hurdle, then you're going to meet that test. And then the third test is when you have this technical challenge, how do you overcome it? Well, you need to go through an experimental process. For example, maybe you have a concept and then you develop some experimental machinery to do better harvesting techniques, for example. And then you have to test that prototype or that functionality. And there's problems or failures. For the R&D credit, we love problems or failures. I know businesses don't like that, but it shows that there's a lot of process experimentation involved. Trial and error testing, you try something, it doesn't work, you have to go back to original designs, make changes. So it's that whole iteration involved in trial and error testing when you're developing something that's new and improved. And then lastly, you have to fundamentally rely on a hard science. So, in the wine industry, we're looking at physical sciences, we're looking at, biological kind of sciences, potentially engineering or computer sciences as well. So we're going to look at all of these kind of activities and technologies and see if you're using them in such a way that meets the 4-part test. Now, this is for most projects need to meet this general and broad definition of research. There is something called internal use software. So sometimes we work with businesses and wineries where they're developing some software that's more G&A software, general administrative software. It's not commercially sold, licensed, or leased to your customers. Otherwise, it only has to meet the 4-part test. But if it is truly internal use software, just used internally for your business needs, then it has to meet an additional 3-part test. And this is a pretty high hurdle. Generally, the IRS and the government, they don't really like internal use software claims. Doesn't mean you're not qualified, but you need to really make sure that you meet additional 3 tests. So you have to meet the 4-part test I talked about earlier, and then you have to meet these 3 additional tests. So the additional tests are, it can't be commercially available. So if this software, you just buy it off the shelf, plug and play, that's not going to meet the test. So it has to be something non-commercially available. You have to incur significant economic risk. So this means you're committing, hundreds of thousands, if not millions of dollars into this software development activity. And because of the technical risk, you may not be able to recover that investment over, a reasonable amount of time. So if that's the case, then you would meet the significant economic risk test. But the big one is the software needs to be innovative at the end of the day. So it either significantly reduce costs of the software program, improve speed significantly, or show some other substantial measurable improvement. So this area, we could spend an hour on software development and internal use software, which we don't have on this call. But this is an area that can be very complex. So if you do think you're doing any kind of software development activities, especially if it's internal use software, please reach out to us and we can walk you through. There's a lot of case law on this, a lot of code and law that'll help us guide us through whether or not you're going to be qualified for this program. So wanted to talk a little about, what are some of the qualified activities of R&D tax credit opportunities. And this is not an exhaustive list, but I just thought I'd throw out a few of the areas that we see qualification. One is the development and testing a new improved strain of grapes. So that those activities can definitely qualify in your industry. Improving harvesting, processing, or techniques as well. Irrigation systems. So I know in California especially, as we've had years of drought, you want to maximize the use of water, right? And irrigation systems for your vineyards and other crops that you're doing. And so that could potentially qualify activity. Evaluation of geological plot characteristics, for example, soil, grade, water conditions. Some of those activities might be R&D activities that we can pick up. New or improved fermentation, fermentation processes, or filtration processes is qualified as well for this. Now, on the other side here, we also have some general activities that might additionally qualify as well. Technical design reviews, so if you have designs of like new equipment that you guys are developing, those design reviews can qualify. Technical meetings can always qualify. Whoever is involved in these technical meetings to talk about, these research and development activities you guys are working on in projects. Technical writing can qualify. Other, compiling research data and research documentation. Obviously, if you're maintaining that, it's going to qualify. And then we're going to talk about a minute about not only the core people doing the research activities, but direct supervision and direct support can also qualify for this program. So we talked about some of the qualified activities. What are some of the non-qualified activities as well? It's good to know not only what qualifies, but also what doesn't qualify for this. Well, capital expenditures. So if you're just buying winemaking equipment and installing it in your building, that's not an R&D activity. That's not something that we can pick up at cost of the equipment. If someone else did a lot of design and experimentation on new equipment and then sold it commercially to you, right? But if you have a piece of equipment, it doesn't do exactly what you want it to do, and you have different features and functionality that you want to build upon existing equipment, that's where the R&D activities could start. So if you're building a special arm to grab bottles, et cetera, that's not part of the initial equipment that you purchased, some of those design and testing activities can qualify, okay? But generally capital expenditures, no. Training, if it's kind of regular training, that's not a qualified activity for R&D. If something's routine or maintenance activities, that's not going to qualify kind of by definition. It's routine. It's not really research and experimentation. The next one's very important. So activity conducted outside the U.S. is a non-qualified activities. We have a lot of businesses that they use employees outside the U.S. So it's a boots on the ground test for the federal R&D credit. You need to be doing the research activities on U.S. soil. So just be careful that we got to make sure that the activities are conducted in the U.S. for the federal credit. And if you're claiming a state credit, for example, California, the activities have to be done on California soil. Okay, so just something to be careful about. I did have one client that they were actually a software developer and they were doing work out of New Jersey, but they were outsourcing subcontractor work out to the Ukraine. And unfortunately, the activities were done outside the U.S. and they weren't eligible for R&D credit. So you just got to be careful. Always have to ask that question. Where is the activities being done, whether it's an employee or a contractor that I'll be talking about in a minute. Activities in the social science, arts, humanities don't qualify. Research after commercial production, once you've proven out a technique, a process, a product, and it's commercially viable, that's kind of where the R&D activities stop. Advertising, promotion, no. Reverse engineering is kind of an interesting one. I always use the example of if you're Apple and you're developing a new iPhone and you buy a Samsung Galaxy phone, if you pull it apart and see how it works, the hardware, software, firmware, that's reverse engineering. That's not a qualified activity. But if you take that knowledge and you try to develop a new iPhone, if you're Apple, then that's where the R&D activities could start. So just be careful if you're doing any kind of reverse engineering of a competitor's product or process. That might not be a qualified activity. Funded research, we need to be careful. The taxpayer that enjoys the benefits of the R&D credit needs to be the one that's funding the R&D costs. So if there's a third party that's funding your R&D activities, you might not be eligible for the R&D credit for that amount of those funded research costs. Selling existing products, no, you've already proven it out. Travel, admin. So generally, if there's any other marketing or general administrative activities, that's not a qualified activity. So just be aware of, we really have to bifurcate between the qualified activities that someone might be doing and then the non-qualified activities. So we talked about the qualified activities. What are the expenses we can pick up for the R&D credit? Well, there's really four major expenses that we can pick up. The first one is salaries or wages. So any employee, like a W-2 employee that has W-2 box one wages, taxable wages, we determine how much of their time is devoted to R&D activities, and then we multiply it by the qualified percent in the given year. We multiply by the wage for the year to come up with a qualified wage. This includes direct supervision and direct support. So not only the key and frontline engineers, scientists, are they not only qualified, but if you directly supervise someone that's doing direct research activities, that time can qualify as well. So a lot of times you'll see, VPs, executives, even the president of some of these wineries and owners, they're directly involved in the winemaking process and they might have qualified wages. So just be aware of that direct supervision can qualify even if they're not doing direct activities themselves, and direct support. So if you have someone like, perfect example, someone maintaining lab equipment or R&D equipment, if they're cleaning that, maintaining it, they can be a direct support wage activity and cost that we can pick up. The second one, and this is applicable in the wine industry a lot, is supply costs. So if you use or consume the supply in the R&D activities, and that could be a new crop, experimental crop, new grape varietals, in your vineyard. Even if you ultimately sell those grapes and make wine out of them, etc., you could still potentially that could be a potentially qualified R&D supply cost. So we can look into that and see if you're eligible. But it doesn't have to be fully consumed. It only has to be used in research, the supply expense. So R&D supplies, and then contractor costs. So if you hire any outside consultants, contractors, any non-employees conducting research activities on behalf of your company, we get 65% of any eligible payments. There is this 35% haircut for any of the overhead that's built into a contractor's rate per hour. And so the rules say pick up all the costs, and then we're gonna take a 35% haircut. So that's where we get the 65%. Do be aware of, though, that if you're using outside contractors, that there is a rights and risk test. So you have to have substantial rights to the research done on your behalf, and you take on the risk of the research and development and cost. So if you pay someone time and materials, they work 10 hours, and you pay them for 10 hours of their time, then that's probably gonna be an eligible R&D expense for you. If there's a fixed price contract, you may or may not be qualified. So it can get complicated. Some of these contracts, we're very versed in reviewing these third-party contracts for eligibility. So if you have any questions about that, please reach out to us. And then the fourth cost is it's something called rent or lease cost of the computer. When the R&D credit came out in the early 80s, not everyone had their own personal computers or standalone computers, laptops. So companies would, lease, computers to use for R&D, data entry, calculations, etc. Well, nowadays it's more, everyone has computers, but it's more cloud computing costs. So if you use Amazon Web Services, Google Cloud, those monthly services, if they're used to house R&D data, could be a potential R&D expense. So those are the four expenses, the qualified research expenses for the research credit. I did just want to show you real quick, a quick and dirty calculation. This assumes $1 million of R&D spend. There is a base amount in this example. You have to take the greater of the base amount or the 50% of the current year QRE. That's your best case scenario. You get 50% of your current R&D spend. So that's $500,000, and then you multiply it by the credit rate. I talked earlier, the regular credit rate's 20%, but you can't take 100% deduction for your R&D expenses and 100% credit. So what most companies do is they'll elect what's called the 280C. They elect a net credit, and at the end of the day, it's almost $80,000. I mentioned earlier it's 7.9%, which is about 8%, so about 80 grand. So it's an easy way to kind of do a back envelope estimate of how much credit you could see as long as you are subject to this 50% limitation. So you're getting about an 8% return for your R&D expenses, or 80 grand for every million you spend. And the nice thing is, now that the credit's permanent, is you're going to enjoy the benefits of the R&D credit, way out into the future. So there's no reason really not to investigate whether or not you have an R&D credit, because it's not just a one-off thing like some of our other service offerings, like employee retention credit. This will stay with you as long as you continue to do R&D activities. This is going to stay with you indefinitely in the future. Okay. So I did just want to show you, if you guys do have any operations outside of California, there are other states too that have R&D credits. Arizona has a very good one, for example. We do a lot of work in Georgia, which is like 10% credit. They're all a little bit different, though. They all have their different rules and regulations, how they calculate the credit, how they use the base period or calculate the base period in gross receipts, or do they use ASC, the alternate simplified credit. So it can get very complicated. But my point here is, if you do have any activities that are R&D related outside of California, there might be also another state credit opportunity for you. A couple other quick things I wanted to mention about the R&D credit. There's something new for 2022. Historically, companies could always 100% deduct their research and experimental expenditures, and that's the starting point for the R&D credit. Well, as part of the Tax Cut and Jobs Act of 2017, effective January 1st of this year, companies now have to capitalize their R&D expenses and amortize it over 5 years. And this is a big issue for companies that were currently 100% expensing their R&D activities and also taking an R&D credit. They're going to be limited in this year, in 2022, in the next 5 years on how much credit that they can claim and deduct for their R&D expenses. So I just wanted to show what this kind of looks like. So, we have this company, ABC Corporation. They have $1 million in R&D expenses, kind of similar to what I mentioned before. And, the credit rate's 7.9%, and they would normally get a $79,000 credit, right? We looked at that earlier. Well, now you can only pick up 20% in 2022 of the R&D expenses in 2022, or you're only getting 1/5 of the credit now. So you're only getting a $15,800 credit, where normally you would expect to get a $79,000 credit. So this is a big deal. And what's going to happen is the next year in 2023, you're going to get 40% of the credit, because you're going to get another 20% for the current year, 2023, and then you're going to get this carryover, if you will, from 2022. And then it'll be 60%, 80%, and then we'll finally get to 100%. But it's kind of annoying, this law that's in effect right now. This is the #1 lobby issue. There's an R&D coalition made up of the top 50 companies in the U.S. and the world that claim R&D expenses and R&D credits. And this is their #1 lobby activity this year. And we're hoping that they kick this can down the road. There is some legislation and bills that would not make this effective until 2026. So kind of kicking it down the road, if you will. But right now, the law is the law. So we hope it gets repealed, or at a very minimum, doesn't go into effect. But currently, it is in effect. And so we'll see. We'll let you guys know if the legislation changes. It'll probably be something where there'll be a new spending bill in December of this year, and it'll be 11th hour before the year ends, and then they'll probably pass something, either repeal it or extend it to 2026. But we don't know right now. We can only go through what the current law is. The current law is that you have to amortize and capitalize and amortize your R&D expenses over a period of time. There was one other area I did want to mention to you as well. So last October, there was a new legislation that came out, a chief counsel, a memorandum that came out actually October 15th, which is the last day of filing an extension for 2020 tax year. So on the last day, the IRS sends out this memo, and it basically says that starting January 10th of this year, if you have a refund R&D credit claim, you have to have additional documentation before. If let's say you forgot to file an R&D credit claim for 2020, and you want to go back and amend the return and claim a $100,000 credit. Well, before, you could just slap a number on the return and file it and hopefully get your refund back. Well, now they're making you basically do an R&D credit study before you actually even file it. So, and it's pretty onerous. So, for example, you have to identify all the business components to which the R&D credit relates to for that year. So let's say you worked on 30, 40 R&D projects. Well, they want to know, what were all those business components? And this is when you file the refund claim. This is not later on if it gets audited. You have to have this documentation up front. So for each business component, identify all research activities performed, identify all individuals who worked on the research activity, and then identify all information the individual sought to discover. So this is kind of the old discovery test. If anyone was familiar with that years ago, that's a lot of information that they're asking for that previously you didn't need to have. This is something we normally do. When we do an R&D credit study, we always gather this information anyways, but now they're requiring it up front before you even make the refund claim. And then you obviously, the R&D expenses, you have to include the wages, supply expenses, contract research expenses claimed for each year. What happens is if you have you don't have all this documentation when you file the claim, they're going to reject the claim. And I think you only have like 30 days to correct it. If you don't, that's it. You're done. You're never going to be able to get a refund for those R&D credits that you had in those earlier years. So just be very careful. If this is only applicable right now for refund claims for prior years, but we think in the future that the IRS is going to make this documentation requirement on originally filed tax return when you're making those claims. So just be aware of that. We can help with this documentation as needed, but this is something brand new for 2022. Okay, I am going to kick this over to Michael, and he's going to talk about the employee retention credit.
Fantastic. Thank you, Mark. I appreciate it. Thank you, everybody, for tuning in and listening today. So I'm going to go over the employee retention credit, which I'm sure many of you have heard of. Unfortunately, there is a lot of misinformation out there. There's a lot of companies claiming this that aren't really sure if they qualify. So my goal of this is to really help you understand whether you qualify, what kind of industries qualify, talk about how you might claim this credit, and then some of the best practices when pursuing this credit. For those of you that aren't aware, the employee retention credit was an incentive that came out with the CARES Act in March of 2020 when the pandemic hit the United States. And what it was created to reward employers that were impacted by government COVID-19 restrictions, but continue to keep their payroll going. Really, the goal was it to keep Americans employed, and even though their company might have been, impacted by COVID-19 restrictions. Essentially, the way it works is it's related to wages that are paid from March 13th, 2020, all the way through September 31st of 2021. It's a refundable tax credit that offsets the Social Security tax that the employer has paid on behalf of their employee. The really nice thing about this, though, is because it's refundable, if you have more credit that you qualify for, then you pay taxes and you actually receive all that back as a check from the IRS. So it can be a pretty significant benefit, seeing that you can get up to $26,000 per employee. And it's a very good reward for those employers that continue to keep their payroll going during the pandemic. There's a couple different ways that you can qualify for this credit. The first way you can qualify for this, and this is the one that most people look at and determine whether they feel they qualify, that might not be the case, is the revenue test. First, they look to see if they had a drop in revenue in any single calendar quarter in 2020 when compared to that same calendar quarter of 2019. If they hit that 50% drop, they automatically qualify for that quarter. And what the government did for 2021 is they actually lowered that threshold from 50% to 20%. Now, still compared to 2019, as 2019 will be the base year and the comparison year, but in 2021, you only have to hit that drop of 20%. Now, what a lot of people don't realize is that if they don't hit that drop in threshold, they still may be able to qualify by the government order eligibility test. And essentially, this is where the complications of this test comes in. It says, can you show that your business was more than nominally impacted by government COVID-19 restrictions during any single calendar quarter during that time period of March 13th, 2020 through September 30th, 2021. And that's something that I'll get into a little bit later to dive into more of the details for those that are wondering how they might hit that more than nominal impact. But a couple quick, real important things is it is not available to everybody and all size companies. It is limited in 2020 to companies that had less than 100 full-time employees on average during the 2019 calendar year. And in 2021 to employees that had less than 500 full-time employees on average during the 2019 calendar year. In 2020, if you qualify, you're able to get up to $5,000 per employee, which essentially is calculated as 50% of $10,000 of qualified wages. Now, we do say qualified wages because you have to back out things like the PPP loans and several other grants that you might have received. But essentially, at the end of the day, the maximum credit you can get is $5,000. In 2021, as I mentioned, this is eligible for the first 3 quarters. So you're looking at about 70% to get to $7,000 per quarter, up to a total of $21,000. So as you can see, if you're in a business that was really heavily impacted during that 7-quarter period, you can get up to $26,000 per employee, which can add up very quickly, especially if you're between that 100 and 500 employee threshold, if you will. Now, what I really want to dive into is the full or partially suspended test. This is where the most confusion of really the employee retention credit comes and where a lot of information is. You got to love, there's not a lot of guidance by the government under this, and it's pretty typical for these credits to leave it a little bit open-ended for interpretation. But typically what the Employee Retention Credit CARES Act provides and what the IRS came out with is, can you show that basically your operations in 2019 when compared to 2020 or 2021 could not operate at the same capacity? Now, I want to get into some examples here that is really going to kind of show what we're looking at. So these industries are all industries that here at CTI, we've been able to show that there was a more than nominal impact. For example, wineries are a very big part of our business that we work with. Most wineries that we have worked with have tasting rooms. Now, they were obviously impacted because they couldn't have indoor tastings, or they're limited to the capacity of how many people could be inside during a certain time period, or they had to shut down altogether. I know here in Sacramento, Sonoma County, Napa County, during a long period of 2020, you couldn't have any tastings at all. During that time period, even if your revenue was up, we can still show that your employees were not as impactful as they might have been serving everyone at their wineries. So we can show that there was a more than nominal impact for those types of industries. Now, all these other industries, there's a lot in there. I'm not going to go into every single one, but restaurants, senior living facilities, all impacted because essentially what we're trying to show is that they could not operate in the same capacity that they operated prior to the pandemic in 2019. We're also now one thing that's really unique to this credit is we can actually work with non-for-profit companies. As Mark mentioned earlier, this is a payroll tax credit and not an income tax credit. So a lot of the nonprofits that we work with that have different fundraising events that meet in person, even religious organizations, they weren't able to meet together, if you will. Anything like that, we're able to show that because of these government restrictions in place, they qualify in this target area. Now, what we do here at CTI is we do a full analysis of your company as a whole. Even if part of your company was considered essential, if we can show that another part of your company was not essential, you're still going to be able to qualify for this credit. And that's really important to know. What a lot of the misunderstanding comes from is we just have to show that there's at least a 10% impact due to these government restrictions here to your business. So if you do have any other questions on these specific industries that you might fall under, I'm happy to get into it, but we have some case studies that I'd like to show you here. This is examples of actual industries that we've worked in and been able to help claim the ERC credit. And you can see it can be some pretty significant numbers. The first is a K through 12 private school. Now, they had 380 employees, which is somewhat significant, but as you can see, they're able to get up to $4.2 million for the whole program. And that's really due to the fact that they had to go to distant learning. They couldn't do things. The cafeteria wasn't open. The library wasn't open. Their transportation services obviously weren't working. So those individuals that were employed in those types of business weren't able to be as effective as they were prior to the pandemic. They were rewarded $4.2 million from the government because of this. Electrical contractors is another example of a company that actually was considered essential, but was impacted by the pandemic. And this was really due to the fact that they weren't able to go out and visit their clients. They weren't able to go do what they needed to do in their business. So they had a lot of people, sitting in the office, kind of twiddling their thumbs, not being as effective. And that's where we can really show that because they weren't being effective and still being paid by their employer, the employer was rewarded because of this. And as you can see here, again, a very significant amount of money at $1.5 million. Now, the last example here is a cafe restaurant that we've worked with here in California. Only 51 employees, so not a really large operation, but they were significantly impacted by limited capacity seating indoors. They were shut down for quite a while, and then they were rewarded about $350,000. Again, for individuals that are most likely part-time workers, most people in this industry are jumping between restaurants. That's a pretty significant amount of reward for these employers to be able to help out with the pandemic and who were really struggling to stay afloat. So really, there's a lot of different ways that you can qualify for this credit, but ideally what we really want to look at holistically is how the business operated prior to the pandemic and then how it operated during the pandemic. And if we can show that there was an impact that was either financial, whether it be revenue or net income, or a cost increase because of protective equipment you had to purchase for your employees, or we can show that your employees were not as effective because of these government restrictions in place, we're going to be able to qualify you for that time period. So again, if you're in California or really any other state, it's definitely worth a while to take a second look at this credit because you may be eligible for this reward from the government to help you stay afloat, even past the restrictions that were in place. So what I want to touch on briefly is another service offering that we have here at CTI called the Work Opportunity Tax Credit. And what the Work Opportunity Tax Credit was created years ago was to essentially reward employers for hiring individuals that might have had a barrier to get into the workforce. There's 14 different specific targeted groups that you look at that may qualify, and we'll get into that on the next page. But essentially, the way we look at it is, if you're hiring people that fall under this target group and they work for at least 120 hours, you potentially could be eligible for up to $2,400 to $9,600 per employee. Now, this is an income tax credit. So similar to the R&D tax credit, it's going to offset any income tax that the business is paying. Now, the employee must complete a certain form. Essentially, it's a questionnaire to figure out if they qualify. Then they have about 28 days to essentially send this in and get certified by the government to be able to qualify for this credit. Now, what we do is we have a very stringent process where we work directly with your uploading software when you're uploading and hiring people and onboarding these individuals, that this information is getting sent directly to our project managers, who very quickly process this information, do the calculations, and make sure that we're getting the certificate from the government to see that you actually do qualify for this program, and then you qualify for the amount that is determined under that certain specific target groups. Now, the different target groups has 14 different target groups on here. And as I mentioned, this is really created to incentivize employers to hire individuals that haven't been working or may have had a really hard time getting in the workforce. It's really a benefit for both parties because you're getting a new employee as well as helping those that have really had trouble getting into the workforce. So as you can see here, on the left side, there's a handful of targeted groups that are veteran target groups. So if you're hiring individuals that are veterans, whether they've been unemployed, whether they were, they're disabled in battle or whatever it may be, they're going to be able to qualify under this program. Non-veteran target groups include individuals that might be on food stamps, long-term unemployed individuals, or other individuals on some type of government assistance. So if those types of individuals get hired, then the company is essentially incentivized to get these types of credits and incentives. Now, this is really one of those programs where if you have a lot of turnover, it makes sense to hire a consultant to help manage this. So if you do have any questions on the Work Opportunity Tax Credit, the groups or how it may work, please feel free to reach out to us, and I'm happy to go through that for you. With that being said, I'm going to pass it back over to Mark, who's going to go through cost segregation with you.
Great, thanks, Michael. Appreciate it. Yeah, so we just had a couple of slides on cost segregation and fixed asset review, and really the point of this program, it's a timing play. So you basically, with this program is if you're buying buildings and they have a depreciable life of 39 years, what we're trying to do is separate the personal property from the real property. Someone said, if you grab a building and you pick it up and shake it, whatever falls out, you can actually have shorter lives for those assets. It's just one way to work at it. We're trying to move the property from a 39-year, 27.5-year to like 3, 5, or 7-year property. So you get more of an immediate deduction for some of the and depreciation on these assets. And what we're really looking for is, if you buy a building, generally if it has depreciable basis of more than $1 million, that could be good, or improvements of over $500,000, and then placed in service as far back as 2000. Example of property, could be any kind of office buildings, it could be shopping mall, warehouses, any kind of facilities, even single resident, rental, assisted living facilities, golf, manufacturing facilities, anything out in the winery buildings. That something where you're doing improvements to that, and we can separate that personal property from the real property. So we have a great team of engineers and former construction managers that they'll go on site as needed to see what the benefit is and what the assets are, and try to carve them up into a shorter life for you. So that's one service that we offer. Let us know If you guys have purchased any buildings or made improvements or built buildings from scratch, we can get involved early to help you out with that program. The other area I wanted to mention too is I don't know if you have any businesses or looking to expand into outside of the U.S., but as I mentioned before, we do have a global incentives team in London, and there's really two kind of areas that might be applicable if you do business in Europe, for example, or other areas or countries. They also have R&D tax credits in various countries. So the UK has R&D credit, Ireland, Germany that's refundable. There's a Canadian R&D credit, so that's in North America that's very good. They call it the SHRED is the acronym. We can help with those programs. So that's it'd be an income tax credit. Most of these, some are refundable. And then on the other side here, there's cash grants. So if you're looking to expand into Europe and other areas, the European Union is going to give you money to encourage businesses to relocate and set up operations in certain EU countries. So we can help with those grants. It's not guaranteed you get those grants, but we're very good at the grant writing to give you the strongest case that you can get the grant. And you don't have to pay that back, which is nice. These R&D grants, or if it's for employees. So it can be very complicated. There's a lot of programs out there, especially in Europe, but we can help with that. We have a team of a half a dozen that's all they do is R&D incentives as well as cash grants for that. And thank you, everybody. I know throughout the presentation, you've been submitting some questions via the chat, which is great. Let us know if we can't answer any questions today. We would love to, have you reach out to us. One of our colleagues, Adriana, she's in, like I said, in Sonoma County, Northern California. She works with a lot of wineries and a lot of businesses, and they're related CPAs in Sonoma County, Napa County, throughout Northern California, throughout the U.S. And you can reach out to her if you have any questions at all about any of this. Please reach out to her, and she'll get in touch with Michael and myself or others at our firm to help out. So we really appreciate you guys' time today. Hopefully this is informative, and have a great rest of the day. Appreciate it.
Mark, Michael, that was really informative, a lot of information, but I think you laid it out in a way that's pretty digestible. Just a couple of questions that I have that I think some of the folks in our audience might have. For those wineries that did qualify and receive the PPP loans, could you talk a little bit more about the fact that that doesn't mean that they still don't qualify for the employee retention credit?
Yeah, absolutely. And I would say about 90% of our clients did take the PPP loan and is also taking advantage of the ERC. Typically, during the PPP loan forgiveness process, you'd pick between an 8-week period and a 24-week period. And you can also segregate the cost between payroll costs and non-payroll costs. So we take that into consideration. But if you do have that 24-week period, there's a lot more than 24 weeks that are eligible to qualify for the ERC. And we're going to be able to maximize it outside that 24-week period. Typically in 2020 and 2021, we've seen that we've been able to maximize both the PPP and the ERC because of that limited time period of the PPP. So absolutely, they can take advantage of both.
Now, is there a deadline that's out there for applying for the employee retention credit that the audience might need to know about?
Yeah, so typically it is a payroll tax credit, as I mentioned. So you have to amend your payroll tax return on a quarterly basis. So you have up to 3 years to amend your quarterly tax returns. So the first one that we're coming up on is the Q2 2020, which you still have about another year to file for it. So there's not an immediate deadline, but there is one that will be coming up.
And for those, wineries or we work with a lot of wine industry vendors as well that I think should be taking advantage of the program. If they're not sure if they qualify, does it cost them anything just to have a conversation with you and figure out whether they do qualify and what they might qualify for?
Yeah, no, absolutely not. So typically my days consist of meeting with different companies and having a 30-minute consultation. I've personally done over 100 of these studies myself. I'm involved in over 200 of them, and our company has done about 3,000 of them. So I can tell pretty quickly based on a consultation about 30 minutes, understanding more of your operations, how you were impacted. I can pretty much tell from that conversation whether we feel you would qualify or not. If you don't, there's no charge or anything to your time.
So yeah, no risk to having the conversation. Then, and what are you seeing in terms of like audits from coming down? And talk me through the kind of support that you offer in the unlikely event that there is an audit.
Yeah, absolutely. As of right now, there has not been very many audits. Again, though, this is very new, and the IRS has up to 3 to 5 years, depending on which time period you claim, to audit this. So my expectation is that this will be audited more in the future. And that's why the way that our company operates is that we're making sure that we're having enough documentation and substantiation for each claim, that if it is questioned, that we're going to defend it. So we're always going to make sure that, let's say the IRS comes knocking in 2 years, our tax attorneys are going to defend the work that we're doing. And that's why we're going to make sure that we document it now rather than scrambling later for something that might have not be there anymore.
Right. And I guess, one of the other big questions you're going to get, or that you do get, I'm sure, is the timeline. So what should people expect with respect to, from the time they actually start working with you guys and when they can expect to receive a check from the government?
Yeah, absolutely. It is a process. So on average, it takes about 90 days to work with us. That includes a buffer time because we know you have a day job and your job isn't just to get us the information we need and to go through our review. From there, it takes about 6 months for the IRS to refund you back your money. That's really why you want to get started as quickly as possible. Get your name in line. That way, the quicker you do it, the quicker you're going to get your money back.
Great. Switching gears a little bit, I want to ask you just one question about the R&D credit. A lot of wineries and vineyard operations work in conjunction with industry vendors to focus on, some maybe a new innovative product in the cellar or in the vineyard. So they basically work in partnership. Is that something that the wineries and vendors do they work together on applying for that, or is that something they have to do individually?
Yeah, I was just going to say, unless they have like a joint venture agreement, they would get their R&D activities and credits separately for each business that's doing it. We would want to look at the, a contractual arrangement between the two entities just to make sure that, they do have the rights and risks associated with each one. But that's something that we can look at. Certainly, we've seen both sides receive credits for similar endeavors that they're doing.
Yeah, well, so it may be more applicable to the vendors out there that are working in conjunction, with the winery vineyard operations to come up with new products. But well, guys, listen, thanks again for your time. Super interesting. Appreciate it. Appreciate the sponsorship, and look forward to working with you in the future.
Yeah, thank you for having us, George. We really appreciate it.
Thank you. Appreciate it, George.